Why is today such a big day? We have the FOMC. This is a meeting of all of the Federal Reserve presidents. All right, so the meeting minutes are going to drop. Now, the meeting minutes for the FOMC are just a recap of what was discussed in the previous month's get-together. Okay, so this is for December. Now, the market has been going insane for the past year and a half, ever since the Fed dropped the rates. Because once again, and I've done many YouTube videos, you can look at them, where it talks about how, the rates were dropped, cheap money, investing, economic boom and whatnot. Everyone has been watching the inflation numbers. Your CPI, your core inflation, your PPI, your producer price index, everything. Prices going up, up. Transitory my ass. The Fed has to slow this down. They have to stop this, okay? Or at least help stop it. This is part of their own doing, but they didn't really have a choice. Now, before you ask me about anything, the Federal Reserve doesn't give a shit about the stock market in the same context that we do, okay? They care more about the value of money, and they care about making money and stability and power and control. As it goes up, it continued to go up at a higher pace because they couldn't stop putting out money on the printer because we weren't recovered economically. We needed people to keep spending, people to keep consuming, the GDP to continue to grow. So instead of slowly easing this out, they had to push it off and push it off and push it off. And now we've gotten to a point where we have to come to a hard stop, or else this is going to get out of control. They have been pointing that employment levels were their most important indicator. And on the surface, it looks like that's come to normal. We got unemployment all the way down from 12% to 3.9 or whatever percent, and jobless claims have gone from 6 million people to 200,000, per report. These are misleading numbers. I've broken this down before. This doesn't count people that have stopped looking for work. And the reason that people have stopped looking for work and aren't being counted is not only the 4+ million people per month that have walked away from their job for the last 6 months, but the fact that there are 11.9 million open jobs right now. And despite the fact that personal income and starting income and corporate, everything, even entry level has gone, as much as double what it was 2 years ago, these jobs aren't getting filled. Regardless, the Fed has to step in. Okay, now that we got that out of the way, let me give you guys an idea. I'm going to give you guys a little chart so you guys understand what we're talking about, okay? This is the Federal Reserve rates over time. And this is basically, I'm not going to give you the exact, every step status, but I'm going to start at 0%, 2% for this, and then we're going to do 10%, 15, and then 20, okay? This is the rates, okay, to borrow money. You're thinking to yourself, Stocky, why would you go as high as 20? Well, get ready. This is basically what rates have looked like, okay, over time, starting in 1950, we'll start, okay, to today. It looks like a lot of y'all's portfolios. 1950, 1980, today. And you're saying to yourself, Stocky, I don't understand what this chart means. Okay. Does anybody know why rates went that high in the 1980s? Inflation was going insane. And the Federal Reserve chairman at the time did something that everyone hated, but he saved our economy. Between the oil crisis, between everything that was going on internationally, the Cold War, and everything, inflation was running away. I'm forgetting the 70s, though. I should probably put the 70s spike in there. Let's talk about inflation rates during this time. In the 1980s specifically, okay, inflation was at 12% sustained. 12% sustained. Federal Reserve chairman pulled the brakes, and we saw rates go as high as 20%. Nobody was borrowing money. Mortgage rates were as high as 17%. Now, the average house cost $80,000, but still 17%. Adjusted for inflation, it's still cheaper than today's houses, but think about that, 17%. But you know what it did? It stopped it dead in its tracks. And we saw inflation rates within 5 years go all the way back down to 2%. Not fun for, we didn't have tech stocks like we do now, so they would not be fun for the economy to see that. Now, it was great if you were buying bonds or you had a savings account, because banks needed money. They couldn't borrow it at that expense, so they're getting it from their customers. And how do you entice more money for you to use at a cheaper valuation? You raise the interest rates on savings accounts to entice people to put their money in the bank, and then the bank can then do more with it. Even with fractional reserve lending. Okay, so that entices it. Okay, so that's where we were at in the 1980s. Okay, now with that being said, let's move on to the next one. We saw the Fed start cutting rates as soon as we saw the inflation numbers start to go down. They started cutting rates, right? They started cutting the rates down because they don't want the economy to grind to a halt, but they just had to pull the Band-Aid off for inflation. And so we ended up seeing a big pullback in the rates. All right, we started seeing a huge drop for the course of 5 years. And we ended up seeing them drop it in the next 5 years, all the way down from 20% to about 8%. And what happened? People started getting money again. And the economy started to, get back to its thing. Then 1987 happened. Okay, that was our energy crisis. And then we saw the spike and they had to raise rates again. They were much more active back then. And then rates got cut again after the Gulf War, all the way down to 3%, which today we think is crazy high. Then we started seeing the dot-com bubble. Everybody started jumping into every dot-com trying to make money. People were getting loans. People were putting up their houses. People were putting all their money. Yes, Enron happened and the Microsoft breakup happened during that time. And then the dot-com bubble burst. We saw Amazon at like $6. And so what do when you hit a recession and everybody's hurting and the economy slows down? You cut rates. So now the Fed cuts the rates again, but this time all the way down to 1.75% to get us out of that crash, as it were. Everybody takes their money. Everybody buys in the market cheap. Everybody buys the housing pushback. Everybody gets back in. Guess what? Inflation starts going up. They raise rates again. They raised rates in 2007 when the housing market, the real housing bubble started. They raised rates all the way up to 5%. Got to slow it down. And then boom. If you were old enough to live through 2007, 2008, and you had capital that survived through that time, you were given one of the greatest opportunities in history. A massively inflated housing bubble absolutely crashed. People were liquidating at pennies on the dollar, and they dropped interest rates to 0%. So if you could afford to, this was one of the greatest transfers of wealth in history. A lot of people don't know that. A lot of wealthy people lost money, but the real wealthy people got bailed out or were able to recover it easily by buying up all of the real estate and stocks from people who didn't have money because they could borrow large amounts of money at 0% because interest rates were low, and then get mortgaged out or buy out properties at pennies on the dollar and then throw the rest of that money into the market. Coronavirus was the quickest large transfer of wealth in human history ever. So guess what, guys? We saw rates go up again. And then 2008 happened. Rates go to 0. And then we start seeing money flow back in. Housing starts going. We had a little housing pullback in 2012. And money started going. We started getting too much money out there. Fed's like, okay, we got to make sure that we don't get into a sticky situation. Let's raise the rate. So what happened in 2018? Rates rose back up all the way above 2%, 2.25%. At the same time that we had the Chinese trade war. And from September 28th to December 24th, saw a 22% correction in the market. But then everything was fine. Rates came down a bit. Stability came. Corporations were running wild. Gridlock was in the House and in the presidency. And we started going again. Then 2020. And so, of course, they cut the rates down to 0 again. The difference this time is unlike some of those other times, massive loss of workforce, international halt, not just from over-leveraged equities or commodities or housing markets or credit. No. Actual GDP reversals, actual GDP slowdowns, legitimate mini recessions all across the world. So they had to keep the rates at 0. They needed much more stimulus. They needed the government to be able to give out checks to unemployment. They need to give out stimulus. They need to give out child tax credits. They need to give out, money for housing. They had to keep people floating, and they had to keep money in people's pockets in order for them to keep spending, which in turn hires people, which pays more money and trickles all the way through the world through manufacturers and producers and shipping and everything like that. And it kind of worked until it kind of overheated. Now everybody had money. Everybody was at home, and everybody started buying shit. And everybody started buying shit that needed stuff that couldn't keep up, and then you get a supply chain disruption, which then causes the PPI, the producer's cost, to go up. They pass that off to the consumer, who now have more money than ever. I mean, personal income was at the highest it ever was. Savings was the highest ever was. I mean, think about it. You're making $6, $7 an hour at McDonald's, but you get laid off or you quit, and you're able to get, the equivalent of $25 an hour on unemployment for a year. You have all this extra money. And the degens here blew it all on weeklies, but people were actually buying shit, and there was this massive influx. Then we hit supply chains. And so now those price increases happen, and people have the money to pay them, and we just keep seeing this inflation, but the Fed can't cut rates yet. And so now here we are, all this crazy fucking shit. So now we're at a crossroads where inflation is going out. Now, true inflation numbers are way above 7%. Depending on how you look at the numbers, how you do it, it depends. Inflation's running away. Not runaway inflation before somebody tries to go nuts on me. it's running away. And the Fed has to put a stop to it. But because they kept pushing it off so much, they now have to do a more drastic cut. I don't think we're going to see the same as the 80s where we just get a full stop. But there's three things at play today. Whether all of them come out or not, I don't know. But there's three things I'm focusing on today. One, rates. How much? How many? I can't call bull or bear because I don't know what billions of dollars, trillions of dollars are going to do. But we've priced in 4 to 5 rates this year. And as much as, that's on the many, and as much as 50 basis points today. On how much? That's kind of what we priced in. Whether we get those exact numbers, we won't know. We don't know, but that's kind of what we're looking at. We're at 0%, guys. All right. We were 2 years ago, or right before the COVID impact, we were at 1.75%. So we need to get close back to that because we have to bring inflation back down. Then number 2 that I'm focusing on is tapering. I've already done YouTube videos and all this, but I'll just break it down. Currently, they have been buying $120 billion per month from the government in mortgage-backed securities, T-bills, the whole 9 yards. They've been doing this for 2 years. They have moved their balance sheet from $6 trillion to $9 trillion. It's just unheard of. So they're going to taper it. Are they going to continue tapering, and how aggressive are they going to go? They basically said we're not going to drop the 80-20 million or 20 billion, or sorry, 80-40 billion in treasuries and mortgage-backed securities down to 80 total. We're probably going to drop it down to 105. So they're still going to buy, but just at a lower pace to kind of like ease us out. But they were saying that for the last 7 months. So we may be getting to a point where they have to actually expedite that. But the one thing that I'm going to be paying attention to, at least not on the daily, but like for the rest of the year, and this is just me personally, everybody's focusing on rates, is balance sheet clearing. Okay, what do I mean by this? Remember this 9 trillion that they have? 6 trillion is crazy, but that's manageable according to them. They have to clear $3 trillion. How do you do that? Well, if you own treasury bills, especially short-dated ones, you either have to sell them off or bring them to maturity. If they say we are going to start in March clearing $100 billion per month every month for 24 months or 36 months or 30 months or whatever, that's a lot of T-bills hitting the market. This could drive up rates through the market and not through the Fed directly. Keep a very close eye on the 10-year today. 2 year is important too, but the 10-year is more important. Keep a very close eye on how this moves on people's reaction to whatever they say. It's not just T-bills, guys. It's also mortgage-backed securities and other things. I'm just saying that it depends on how this allocation, how fast and how quick and how much. I mean, maybe they bring them to maturity. I don't know, and they get the money back from the government, but I don't know what they're going to do. I'm just saying my biggest thing I'm focusing on today's report is the balance sheet clearing. So this is what is at stake today. And for somebody was just asking, they said, Stocky, if we knew this was coming, why is the market just now reacting? Because every month that they kicked the can down the road, everyone knew that it was going to be more drastic when the time actually happened. And because people think this is going to be the one, this FOMC meeting is going to be the one going into the new year after all the inflation reports that kept going. They retired the word transitory, and March is coming up, and everything going on. The market's pricing in that this is the one where they're going to announce something, and it's going to be more drastic than it would have been 7 months ago because the desperation is kicking in. As far as not desperation, but the urgency. Thank you. The urgency is kicking in, and that's what everybody's looking at right now. Not to mention that we're getting more negative news about supply chains and COVID and Russia, Ukraine, but that's where we're at. And I know there's probably a couple people out there, it's their first time here, they haven't been here a while, and they're kind of looking at it. Why does the Fed going in interest rates mean that the market falls? I don't get it. I'm new to this. I don't understand. Good. You sleep better than I do at night, but I'm going to tell you why. Remember what we talked about with inflation and rate cuts? All that money being pumped, okay, those big bags of money being shot out of a cannon that everybody's throwing at the market, throwing at real estate because we had this thing called TINA. And I was a big believer in Tina. Big believer in Tina. Every guy I know has been in Tina. And that is, there is no alternative. In other words, there was nowhere else to put your money. You can't leave it in your bank account when you've got 3 to 7% inflation. You can't put it in a savings account. Rates are down. Nobody's getting paid interest. You don't put it in CDs. Those are trash. Bonds are trash. You got to put it in equities. Or real estate, or crypto, when you bought Doge at 70. I told all of you fuckers right before Elon went on Saturday Night Live, get the fuck out. But here's the thing. Stocks will continue to go up if people believe that the value will continue to go up. There's 2 things that drive value. A company's growth, or people with a lot of money that'll just keep buying it because they have nowhere else to put their money, and it just keeps rising the price. So the idea is if money is less accessible, it's more expensive to borrow money, less money will be flowing, meaning less money will go into equities, meaning the chance of this giant overvaluation to continue up is going to stop. So they're like, all right, fuck it. I'll take my profits here. And that drives prices down, especially in technology, which is the biggest runner on good days and biggest dropper on bad days. Now, there's a lot more to this. I'm just throwing it out there, but I mean, look at housing prices. Mortgage applications have finally fallen. Mortgage rates have been giving a bit of a preview of what people are thinking. Average mortgage rates went from 2.75% last year to 3.75 now. For those of you guys who don't own a house, 1% is insane. I told everybody on this channel when we saw the 10-year drop to like 0.5% and the 30-year drop to like 1.5%, I was like, dude, go out and fucking refinance your mortgage. I was screaming at you guys for this. And maybe we're part of the problem. But on a $300,000 house, the 1% could be the difference between $60,000 to $75,000 you pay back. And I told you guys last month I was expecting to see a momentary pop in mortgage applications once people realized that they were running out of time. When the news came out that rates were probably going to go up. So everybody did that. Now, I'm not saying the Fed is going to raise rates and next year it's going to be 4.75 average, so you better go out and do it now or buy a house now or refinance a house. No, that's not what I'm saying. I'm just saying everything is correlated, guys. There's a lot of you guys who never learned any of this or didn't know any of this. And I'm not trying to teach you all of it. I just want you to get interested in it, and I just want you to take control of your finances. I'm not saying it's going to make you rich, but at least you have control, or at least you understand what's going on. You'll get taken advantage less often, and you'll have more control of your own destiny and your own life. And for some of you guys, you may feel like you never have anything interesting to talk about or never have anything to sound smart or be able to be in those big boy conversations. There you go. Now you got a few things. Maybe you can impress somebody. Just don't be an asshole. I kept the mom, dick, and sex jokes out of this one as much as possible because I think there's people here that are actually really, really curious about what's going on.